Hi everybody, and welcome back to FANG Friday. This is Ross Healy, the chairman of Strategic Analysis Corporation and the senior portfolio manager at McNichol & Associates Asset Management. Yeah, listen, I know that Remembrance Day was yesterday, but I do kind of hate to take my poppy off. Okay, there is a lot to be thankful for, a lot to remember. Well, this past week was pretty much neither here nor there for the FANGs. So that allows us a moment or two for some reflections on the kinds of values that we're actually looking at, the history of the trading of these stocks, and therefore the kinds of risks and rewards that holders of the FANGs may be facing. So today, I'm going to take you on a trip with the FANGs through two bear markets, a baby bear and a papa bear, so that you can see for yourself what you're dealing with, and of course, also why, from here on, this may be a very important time for you to stay tuned to FANG Friday. I'm doing this to provide you with a sense of perspective about your holdings and a measure of realism as to what you can expect in the future. And hopefully, best of all, I am doing it to help you manage the rewards and the risks that may lie ahead. But before we take a closer look at the FANGs, as always, I do like to say thanks to everyone who likes this video and all our subscribers. Okay, let's start off with Amazon. And you notice I'm not focusing in on the near term. I'm now focusing in on the sweep of history. And you'll notice in all of the charts now there's a dotted line in there, and that is the trend of the fair market value. Actually, the trend of the earnings, but it's a trend of the fair market values that flow from the company. And therefore, remembering that very senior stocks, okay, that have been around a long time, there is a powerful tendency for those companies to be pulled down to their fair market value, or of course if the fair market value is here and the stocks are here, to go up to them. So when I look at a company like Amazon and I look at its fair market value over here on the right, you'll notice that this company could fall some 73% before it actually gets to solid support. Well, how silly is that? Well, look at the history of Amazon. Isn't silly at all. Look at what happened in the Papa Bear market of 2008. Okay, here the stock actually pulled right back down to its fair market value, and in doing so, it dropped 70%. Well, going forward, of course, what we see is this lovely upsweep, and there's been a few opportunities to trade the stock. The last time that we had, I think, what we would call a bear market happened here in 2020, and when you look at the Amazon chart, it's just a little tiny blip on the long-term trend. Well, listen, that blip was minus 24%. So not to be sneezed at. Given, when I came into the business 55 years ago, a bear market was a 25% drop in the overall market. And here we have a 24% drop in Amazon in that COVID bear market. And it looks just like a kind of a drop in the ocean. So interesting and different perspective. Alphabet, Alphabet's a very interesting stock, because now when I show you the long-term trend, you'll see what I mean when I say, look, the company has been more than 10 years since it actually got to and above its bubble price. That's the BB line here, which is 7.4 times book value. Well, in 2008, look at what happened to Alphabet. Google, I guess it was then called, but Alphabet there. The stock dropped some 65%. Okay, actually below its intrinsic value. Subsequent to that time, there's been a nice expansion of the fair market value, but the growth, hasn't been more than about 15, 16, 18% per annum. So the valuation of Alphabet never kind of got back to where it had been before. Well, very recently, of course, we can see that the increase in the earnings and the fair market value has surged, and with it, so has the stock. But it's got to keep on going, because it's got to break through the bubble price. It's trying, that's for sure. Now, that was the Papa Bear market back in 2008. Let's go and take a look at the Baby Bear market of 2020. And you'll see, again, although it's just kind of a squiggle on the chart, nonetheless, that squiggle was minus 28%. We actually, at the time, caught that one quite nicely, and we got a nice trade through to our FANG Friday viewers at the time. Microsoft. Well, this is a very interesting chart, if I may say so. I show two Papa Bears in this case. The first one back in 2000, and the second in 2008. And in the first case, the Microsoft dropped some 28%, and in the second case, it dropped some 61%. So not trivial setbacks by any stretch of the imagination, despite the enormous long-term surge in the stock. Right now, the stock is right back up against its HB3, which is 16 times book, and that's roughly where it peaked back in 2000. When I look at the fair market value potential of the company over here on the right, you'll see that there is a minus 53% downside risk in this stock. About the same, by the way, as we had back in 2000. So I am watching Microsoft with considerable interest. I've happily been holding it in our FANG portfolio, but it's getting very, very expensive, almost back up to its extreme peak measure. Nvidia, well, again, if we go back to two bear markets, two Papa Bear markets, 2000 and then 2008, in both cases, Nvidia came off some 86%. I think 86% in one and 84% in the other one, before it kind of got its feet underneath it, and had that beautiful run up to 2018. Here we go, by the way, and remember 2018, we had that setback late in the year. Well, Nvidia had quite a drop, and in that drop, I think it was down some 32%. Now, more recently, of course, and that wasn't even a major bear market, it wasn't even a baby bear market for most of the rest of the market, but the stock, it's got some volatility. Well, in the baby bear market of 2020, even so, top to bottom, and it got perfectly to its HB3, and then had a big drop, some minus 42%. So the volatility of Nvidia is not to be taken lightly. Well, we're up almost to the HB6, and I guess now we will see. Apple, a kind of a picture in three parts. First of all, if we go back to the Papa Bear market of 2008, we'll see here that Apple dropped some 56%. The market itself dropped about 50, and Apple dropped about some 56. Apple was in its strong growth phase at that period of time. And earnings and the fair market value, as you can see, really surged. But that was phase one. Phase two was this period here between about 2011 and 2018-19, when the earnings and the sales growth slowed down considerably. And of course, so did the stock's valuation. It just was sort of capped, and it was capped right at its fair market value. But as I've said to you a number of times, what has changed for Apple is not so much that it's growing much faster than it has been in the past, but the company has been buying back stock, and in doing so has tended to push up the rate of the ROE of the company, which has typically, with most of these companies, has tended to push up their valuations as well. Looking ahead, we have to say, well, look, the fair market value of Apple is some 46.8% lower than the current price, so the stock is not without its risks. Netflix, going actually all the way back to the Papa Bear market in 2008, did fall some 52% there, although by far and away the bigger drop occurred in 2011 here, when there was actually a wholesale revision of the outlook and its earnings. But since that time, the company has been growing nicely and steadily there, and the valuation hasn't got really extreme, I guess, relative to the growth of its fair market value. But look, when we go over to the FMV potential of this company, minus 67%. Couldn't happen again? Sure, it could happen again. It's happened in the past, and in both cases the stock has pulled back down to its fair market value, just to pull down to its fair market value, which would still leave it at a price to book of 5.5 times. Okay, that is a major drop from here. So we watch those structural breakpoints very carefully with that company. And finally, well, Facebook, of course, we don't have all that long a history. What we do have, of course, is 3 peaks at its bubble price, leading to setbacks in every case. This first big setback, of course, that was the scandal a few years ago. Here was the COVID bear market meltdown. And I kept calling it Facebook, but of course it's Meta, isn't it? I mean, there's Zuckerberg seizing a potential movement and kind of running around to the head of the parade and saying, this way. Well, okay, maybe, and maybe not. But anyway, listen, sorry, I digress. Getting back to the 2020 setback, the company still fell some 38%. This was one of my great disappointments in life. The stock was so close to the super growth price I thought it would get there, in which case I was willing to mortgage my soul to buy the stock. I probably should have anyway. What gave the stock away, of course, was that the fact that the Standard & Poor's 500 bottomed precisely at its growth price. And of course we had mentioned that on BNN a couple of weeks before that happened. Anyway, when we look at the stock, it's come off its bubble price, and now I see the earnings softening a little bit, and we'll see what kind of risk we're facing here. When I look at the fair market value, relative to most of the FANGs, it's actually fairly modest at about minus 25%. But that, I suppose, depends on what happens from a regulatory point of view. Okay, in summary, I hope that you have enjoyed my tale of 2 bear markets, and more important, that you see what you need to think about in managing your own FANG stocks. Today, I was not trying to tell you anything about the immediate outlook for these stocks, but I am trying to tell you that you should never be overly complacent about them either. The baby bear market in 2020 caused every FANG stock to lose an average of 31%, with a low of minus 24 and a high of minus 42. The Papa Bear market of 2008-9 brought average losses of minus 68%. That's more than twice the impact of the baby bear, with a low of minus 52 and a high of minus 86. As a final note to the FANGs, these have been wonderful companies, and they still are wonderful companies. Perhaps no matter what happens in the market, you should just hold them and not worry. As you have seen from the long sweep of history, no matter what happens, they seem to get themselves on side. It may take a little time, but they do. But I have showed you the valuation risks that they present now, and their history of price action relative to those risks. As you have plainly seen, they are not trivial. Now, I don't want any FANG Friday viewer looking back sometime in the future and saying, oh, I wish I'd paid attention to that SVA analysis. So just stay tuned. What you do with the rest of your portfolio, of course, is up to you. But you know where to find me. And if you would like to know more about how we can help you with your own decision making, just go to info@strategicanalysis.ca. We're here to help. For now, this has been Ross Healy, Chairman of Strategic Analysis Corporation and a Senior Portfolio Manager at McNichol & Associates Asset Management, reminding you that nothing, including investing, is difficult if you have the right tools, as I hope I've showed you today. I'll see you next week.